Monetary Policy of Cryptocurrencies, Explained. Welcome to Crypto Vortex, and today's video will cover key points about monetary policy in the cryptocurrency world. What is monetary policy in crypto? Monetary policy is an important aspect of cryptocurrencies as it affects their supply and value over time. Unlike fiat currencies, which are managed by central banks and governments, cryptocurrencies rely on decentralized protocols for their monetary policy. These protocols use various tools to regulate the supply of a cryptocurrency, such as block rewards, mining difficulty adjustments, and issuance rates. For example, Bitcoin has a fixed supply cap of 21 million coins, with the rate of new coins introduced to the supply gradually decreasing over time. Other cryptocurrencies may use different mechanisms to govern their monetary policy, such as proof-of-stake consensus systems that rely on staking to incentivize network activity and control the supply of the cryptocurrency. Understanding the monetary policy of a cryptocurrency is essential for investors and traders to make informed decisions about their investments. How do cryptocurrencies have monetary value? Cryptocurrencies derive their value from people's perception of their worth, similar to other currencies and assets. The market dynamics of supply and demand play a crucial role in determining the value of a cryptocurrency. The value of a cryptocurrency rises when there are more buyers than sellers, and falls when there are more sellers than buyers. The value of a cryptocurrency can also be influenced by other factors, such as its utility, security, and adoption rate. Cryptocurrencies that are widely used as payment and have a clear use case generally have a higher value than those that are not widely accepted. Additionally, cryptocurrencies with robust security features and a history of reliability are often more valuable than those that have had security issues or vulnerabilities. How will cryptocurrencies affect monetary policy? Limited control over the money supply. Since cryptocurrencies are decentralized and lack a central authority, standard monetary policy tools like printing money or adjusting interest rates may not impact them the same way they do on fiat currencies. This could restrict central banks' ability to influence the total amount of fiat money in circulation. New data sources. Cryptocurrencies generate significant transactional data, which can provide valuable insights into consumer behavior and broader economic trends. Central banks may need to incorporate this data into their decision-making processes. Increased competition. Cryptocurrencies offer an alternative method of payment and store of value, potentially becoming more competitive than fiat currencies. This could put pressure on central banks to maintain the stability and value of their currencies. In response, banks are exploring CBDC projects to counter the threat of cryptocurrencies, which could disrupt traditional banking and payment systems. Improved financial inclusion. Cryptocurrencies can provide better financial access and inclusion to people and businesses who lack access to traditional banking services. Monetary policy may change as central banks consider how a more diverse and decentralized financial system will operate. Who controls Bitcoin's monetary policy? Bitcoin's monetary policy is decentralized and governed by the rules embedded in the open-source Bitcoin software protocol. The protocol establishes the guidelines for creating and distributing new BTC over time, and any proposed changes must receive majority approval from network users. The protocol's issuance schedule serves as the basis for Bitcoin's monetary policy, with a fixed supply cap of 21 million BTC. New BTC is created through mining, where users compete to solve complex math problems in exchange for rewards that include freshly generated BTC. The mining reward is halved automatically every 210,000 blocks, or roughly every 4 years, resulting in a gradual decrease in new BTC creation until the maximum supply of 21 million is reached. This steady supply of BTC maintains scarcity and prevents inflation, making it a critical aspect of Bitcoin's monetary policy. Do stablecoins alter the monetary policy transmission mechanism? Stablecoins are a type of cryptocurrency that can potentially function outside of traditional banking and payment systems and can serve as an alternative form of payment and store of value. As a result, they may have an impact on how monetary policy is transmitted. The traditional monetary policy transmission mechanism involves the use of various tools, such as changing interest rates by central banks, influencing the actions of financial institutions and the behavior of people. However, stablecoins may operate independently of these traditional dynamics and may not be directly affected by changes to interest rates or other monetary policy tools. During times of market turbulence or economic unpredictability, stablecoins may be viewed as a safe haven asset, which could increase their popularity and lessen the impact of traditional monetary policy tools like interest rate adjustments. Furthermore, if stablecoins were to become widely adopted, they could potentially alter the demand for traditional fiat currencies, affecting the effectiveness of monetary policy. To address these potential effects and incorporate stablecoins into their policy frameworks, central banks may need to develop new strategies. How might central bank digital currency design choices affect monetary policy? Scenario 1: Anonymous and untraceable transactions. It might be more challenging for central banks to develop certain monetary policy instruments that depend on transaction data to monitor and control the money supply if a CBDC is created to be entirely anonymous and untraceable. For instance, if a CBDC is entirely private, it could be more challenging for central banks to identify and stop illegal activity, such as money laundering and tax evasion, which might have an influence on the stability of the financial system and the efficacy of monetary policy. The use of CBDCs to execute policies such as capital limits or negative interest rates may also make it harder for central banks to monitor and regulate. Capital limits are limitations on the total amount of CBDC that a person or organization may own. Capital restrictions can be used as a measure to prevent CBDCs from being hoarded and promote consumption, which will help the economy thrive. Capital restrictions, however, may also have unforeseen effects, such as increasing demand for alternative assets or changing the composition of the money supply. When the interest rate on deposits is negative, depositors must pay the bank to store their funds rather than earning interest, i.e., interest rates on deposits fall below zero. This is referred to as a negative interest rate at banks, when a central bank uses a negative interest rate policy to encourage investment and expenditure during economic downturns. A CBDC may also enable central banks to execute negative interest rate policies that promote expenditure and discourage hoarding if they are intended to be interest-bearing. Negative interest rate policies, however, may also have unintended consequences that could increase financial instability by decreasing the incentive for savers to deposit their money in banks. Scenario 2: Transparent and traceable transactions. On the other hand, a CBDC might possibly offer central banks useful data insights into consumer behavior and economic patterns, which could guide their policymaking processes if it is created to be completely transparent and traceable. However, it could also raise concerns about privacy and surveillance. Therefore, central banks will need to carefully consider the trade-offs between these policies and ensure they are designed in a way that supports economic growth and stability while minimizing the risk of another global financial crisis. I hope it was an informative video for you. If you have an opinion or comment about monetary policy of cryptocurrencies, you can share it with us in the comments section. If you like the video, don't forget to like it and subscribe to our channel if you want to be informed about such videos. See you later.